So you made this observation that December rate cut expectations bouncing around like a meme coin. Why is this happening?
That's pretty crazy. We went from like certainty to 50-50 to like, almost certainly not going to cut to now we're like, we're like over 50-50 again. And that happened in the span of like a month. In addition to that, you have algorithms that are indicating how portfolios should be positioned that are saying sell because the momentum's over. And you kind of get this like real cascading fall.
Welcome back to another episode of Network Spotlight. Friend of the channel, Sebastian, is joining us again. This is back-to-back weeks. We're going to be doing this on a weekly basis now. And the reason why is because this is a very pivotal time in crypto. Everyone's got so many questions. What's going on in the market? Are we in a bull? Are we in a bear? Let's just do a quick recap. Last time, Bitcoin continued to make lows. And then also we had NVIDIA, which seems like they blew their earnings out of the water. And then followed by that, there was still AI FUD in terms of it being a bubble. And then we had these rate cut uncertainty headlines. First, it was 50-50 of a rate cut. Then it was 30-70. Now it's, I want to say last time I saw it was like 25-75, something like that. I'm not sure what the latest is at the time of this recording, but that's where we are now.
As of right now, it's a 68% chance of a cut. At least that's how I see
okay, it went back up because of Williams.
He's a New York Fed president.
New York Fed President Williams mentioned that he believes that the odds of a rate cut are much higher, and all of a sudden the ratio went the other way around. This actually brings me to a tweet that you put out recently. So you made this observation that December rate cut expectations bouncing around like a meme coin. I mean, look, we're no strangers to meme coins on this channel, but I think you got a point here. What in the world is going on with these rate cut uncertainty? Like, why is this happening?
So after the last Fed meeting or press conference, Jerome Powell kind of had said, "Hey, don't expect a December cut's not like in the bag." But the market didn't really react to that much, and so it's still been sitting around like a pretty much like a certainty that we're going to see a cut in December, and then there was some announcements out of the White House after the lockdown ended saying we may never see October data for like jobs and so on and so forth. And so that kind of prompted like things to be like, well, hold on, like would the Fed really cut if they don't have data? Like it just would be like probably more likely that they'd be like, okay, well, let's just hold off and we'll see. We can, because like the Fed typically is one where they seem to often believe we can always move quickly or do outsized moves to stimulate the economy. They kind of did this in like COVID and other times as well, where they kind of like wait, and then it's like, oh, they really need our help, and then they can do that. And that's kind of, I think, the general kind of perspective there. As someone who's never obviously worked there, but I think that just seems to be like their operating memorandums or operating their MO. So so that news came out. It was like, okay, well, hold on a second, what's going to happen? And then so that took us from like a 70% chance to upwards to like we were to kind of closer to like 50-50. And then there was some kind of data throughout the week. It was like, okay, hold on a second, we're definitely not going to get a cut. There was like some talk from the Fed, other people on the Fed and stuff like that. And then we got September's job data, unemployment rate 4.4. That's not looking very good. So it's like, okay. And then there was some really interesting commentary.
When you say it's not looking very good, Sebastian, real quick, sorry to interrupt, but when you say the unemployment data is not looking good, are you saying it's not looking good in terms of making an argument for a rate cut, or it's just not looking good for the economy?
Yeah. So a 4.4% unemployment rate is, which is trending up, is not looking good, which would imply you would get a rate cut, which is kind of this weird dynamic in the markets where you can have an easing policy into some companies still having good profitability, like we see with these hyperscalers, in which case stocks can go up while accommodating while the market or the monetary system is more accommodating, kind of adds like fuel to the fire for assets like stocks, even though the reason for that is because there's like a softening in the main street. It's this kind of like classic decoupling between Wall Street and Main Street. And then so like, like it seems kind of weird that you'd think like, oh, the economy's bad, the stock market goes up, but that's kind of that's kind of the game we've been playing quite often from since 2008. But another important kind of nuance was that I forget who at the Fed said it, but they had mentioned that uh the the tariffs really should have had an inflationary impact if they were going to already, and we haven't seen that. And so, as a result, in previous disclosures, people were saying like, okay, well, we're gonna like we're apprehensive to cut rates because inflation's high, and we think it's going to go higher because of tariffs. Now the Fed is saying we don't think the tariffs are going to be inflationary, or as like that risk seems to have waned. And so we're going to be more focused on unemployment, and then you had the unemployment kind of print higher, and then the comments from Fed President Williams today. But that's kind of caused this huge pullback in
You know,
expectations.
going back to the tariffs causing inflation, I mean, I think that there was this debate before. I mean, the Republican Party, Trump, of course. I mean, they were saying that it wasn't going to cause inflation, but I guess nobody wanted to listen to that because, half the time you're right, half the time you're wrong. But now you're saying that the Fed did come out and they're saying, like, we're not really seeing any evidence of this being inflationary.
I mean, yeah, like when it comes to macro, I think like really like it's an important thing to remember that like really nobody knows. We try to get as much like of a sense or a handle on things as we can. No one knows. I think like you could probably Google what really causes inflation. There's a lot of uncertainty around even just like such a fundamental term and factor in the economy. There's a lot of people with PhDs, that pretend that they know exactly what's going on, but like, these forecasts are inherently bad. So it's a bit
Hmm.
tricky. So you do like, some variability, but I think, the comment on the tweet here is just like, like that's pretty crazy. We went from like certainty to 50-50 to like, almost certainly not gonna cut to now we're like over 50-50 again. And that happened in the span of like a month.
It's
So it's
crazy.
pretty
It's like
crazy.
someone is playing a game with us. It really does feel that way. Speaking of playing games, Sebastian, something off the topic. I don't think you really tweeted about this, but maybe you have some insight because you are familiar with the market making industry, in that business and their mindset of a trader. But Tom Lee went on CNBC to talk about what caused this whole like capitulation and just cascading effect downward, and he didn't name any names, didn't name any specific exchanges, but said that it was a bug on an exchange that caused one of the stable coins to depeg to like 65 cents, or that's at least what it showed visually, which created a lot of fear in a lot of the traders. And now you're kind of slowly seeing this like risk off effect from a lot of the market makers, and they're the backbone of the liquidity for the exchanges and for this industry. Curious to hear your thoughts on like, is this just like grasping at straws here? Like, is this just like a typical like, okay, we had the bull market, now we're just people are taking profits, or do you think there's some merit to what he's saying?
Like I'll just preface it by saying like I have no idea. Like I don't have a lot of insight into what's going on in the centralized exchange. That's kind of the their it's like a feature and a bug at the same time. On the one hand, it's like you have some cover. On the other hand, it's like you don't really know what's going on. I mean, on the 10th of October, it was kind of strange how like the one tweet caused like just this insane cascade. That does kind of happen in some larger, more established stock markets as well. So it's not to say that like that's just a crypto phenomenon, like stock markets of like many emerging markets, even the US, right? We've had flash crashes and stuff like that, very recently. So it can happen. But it did seem a little weird. And then what Tommy was mentioning with some of the auto deleveraging is that if you're long and short, and then your shorts start making a lot of money, but the exchange is under a lot of stress, they have this like auto deleveraging kind of function that could like close your shorts. Um, uh, and that might end up happening. I mean, that'll be a profitable trade for you, but it's not as profitable as it should have been, especially if you're also long that asset, and so it can kind of create these gaps in your P and L or profit and loss. And so that uh there's discussion around, there's a lot of like discussion Twitter, of course, like where we're like, hey, this has happened, this like, there's a lot of market makers who suffered a lot of kind of like gaps between where they thought they were covered on their shorts, but then that got taken away, and so they just had this long exposure that was left, and then some people may have like blown up on that. Other people have said that the reason why you keep seeing this heavy selling on you know still to this day in crypto assets is related to one entity or a couple entities like having to like sell assets, notably Bitcoin, to shore up these losses. It's possible for sure, especially with like people who are sitting on Bitcoin. That would make some sense. You did for a long time see like a lot of alts hanging in while Bitcoin was getting sold off, which was, you would have expected like more of a pronounced move in some of the other assets. It's hard to say because usually if you're like in a risk off and someone's like taking control of your balance sheet and they need to sell it, they're not going to do so over like a long period of time. They kind of are little usually a bit more aggressive than that. So it's hard to say. Like I do still kind of think that like a lot of like crypto selling today, Bitcoin selling, maybe coming from some of the ETF positioning. We've seen some pretty notable redemptions there. Could be just momentum traders or like momentum mandates that are continuing to sell, and why you see Bitcoin and other speculative like stocks seeing more of like a read through there is because those were there's just not as much liquidity, and so that kind of has more of a pronounced impact. But at the end of the day, like it's hard to say. You definitely have people on Twitter speculating, oh, if someone's dead, this is them liquidating. But it could very well be like a momentum algorithm that's saying like short more, like what I mean, or sell. That could very well be the case. A lot of these like programmatic asset management or like asset management mandates, they're like they just get their instructions at the beginning of the day. We need to sell, okay, and we do. So, we'll see. I mean, as we're talking right now, I just saw some random tweet come in saying that like there's like 1010 has been explained. They know what happened or whatever else. I don't know exactly what it was. I just saw the headline across my phone. So people will continue to speculate. It definitely was a very significant deleveraging, and didn't feel totally natural. It seemed like, oh, okay,
Yeah.
something beyond that is happening here, and there's been some continued impacts like in the markets there. But again, like I track this UBS speculative assets basket, and it's a bunch of like crypto, quantitative computing stocks, space stocks, all that kind of like life extension stuff or whatever else, and it's super correlated with Bitcoin. So the Bitcoin price. So there's some endogeneity there where there's like some crypto assets in that basket too, but at the same time to have it like so closely tied or traded, it makes me think that this is more of like which some of the tweets I've made earlier this week is just broader, like, managers looking to shore up their books ahead of year end, people kind of trying to rush for the exit after some crowded trades, and just kind of like a continuation of that in speculative assets, in which case Bitcoin or crypto and Bitcoin fall into that.
Yeah, and looking at this chart here, you definitely see a lot of red, meaning there's a lot of ETF outflows happening on the Bitcoin side. And I'm sure same thing for Ethereum. Sebastian, you also follow a lot of notable individuals in the banking industry, like, for instance, Goldman Sachs' Tony P. And he had a take about liquidity, AI, and the road to year end. What can you tell us about this tweet that you had?
He had this note out kind of this morning talking about which I kind of tried to summarize a little bit, which kind of plays on some of the themes I was talking about throughout the week. The idea generally here is that the market overshot to the upside, which is the little arrow you see pointing there, where we broke trend even a little bit, and like that's just in the S&P 500. On some of the more speculative grade index or like more momentum stocks, you see that jump in October being much more pronounced out of the range. So things got carried away to the upside, not like necessarily like full blow off top round, like like we've seen like ending cycles in the past, but things got carried away on expectations around AI, and then momentum, which kind of like plays into that, and now we're kind of bringing that in. But like again, in the context of the broader move since the lows of October, or sorry, of COVID, it's a pretty small dip. So it's, something to be reminded. If you scroll down, we can kind of walk through the Tony P's kind of like reasoning here, which is we didn't have a ton of information because the government was closed. And the information coming out on the AI stuff in particular was like a lot of these scalers or hyperscalers and AI related companies started raising a lot of debt. You're like, oh, okay, well, hold on a second. That changes the risk return profile a little bit. And then you started to hear about like what is going to be the ROI on some of these like data center and infrastructure investments. Meanwhile, China's doing a different approach where they're doing more of like a capital light business and just or approach, and instead of like investing in data centers and like kind of doing like the rote like we're just gonna like overcompute the solution here, they went more of like let's just build a better like a better model, right, a cheaper model. And so then this is starting to kind of question like the return on investment that these are going to have. And so you're like, oh no, this is kind of tricky. But then like what Tony is saying is like he wrote this today, kind of looking back. This is after Nvidia printed good results and all that kind of stuff. And it's like, look, there are physical constraints in the real world. This is something I truly believe in, but like there's physical constraints in the real world where there'll be some overspending in areas probably, but like there's also some constraints that'll probably contain the bubble, in addition to the fact that like people are hypersensitive to bubbles since the real estate crash. Not to say that there won't ever be another one, of course, but people are like a little bit skittish still from that experience. And so, to me, those checks and balances make a really good, nice long-term investment horizon here. Where Tony had mentioned this in his chart. It was like and other people have said this as well, where it's like in the internet day we had MySpace kind of blow that went to zero, and like Netscape and various other like early kind of winners that like kind of died along the way. But the internet, by all by anyone's kind of assessment, has been a success, right? And so probably get something like that in AI as well. But going back, what happened in recent weeks, and if you scroll down here, this is the Bloomberg Momentum Index, and so you see that like kind of from August to October, nice little healthy run up in momentum. And then what ended up happening was its cracks started to be shown. And then if you're a professional money manager, you get paid on like a bonus based on like your like return over a threshold or whatever else. So then if one person starts to be like, well, hold on a second, I want to like lock in my profits because I want to like make sure I get the big bonus check this year, and everyone else starts to do that, then you kind of have this kind of like momentum fall. And then in addition to that, you have algorithms that are indicating how people should be positioned or how portfolios should be positioned that are saying sell because the momentum's over, and you kind of get this like real cascading fall, right? Like the steepness here went from like 10 to 0, which is a smaller decline than we had when on the Trump Liberation Day stuff, but still a pretty healthy fall in line with that. And so I think that's kind of some important context about where we are. Crypto getting caught up in this is like everyone's crypto is just a little bit more sensitive, right? We got people who are trading on so much leverage. They're they're some of these people like got wiped out in memes or whatever it is, right? They're really all trying to like make life-changing money tomorrow. And so when you get a pullback like that, it compresses that, and I think there's a lot more emotion that comes out on CT. But bringing it all together, it's like, okay, so liquidity conditions are looking to improve. We saw the change in the Fed expectations, and so and then with the government being back open again, we probably get some additional spending. The Fed's already said they're probably going to have to go out and buy some bonds next year. Trump's going to do everything he possibly can to get reelected, so we got to think that there'll be some initiatives there. And so the things aren't looking as good maybe as they were kind of in June, but like we're still looking pretty good. And then something that could be interesting for people too is if you scroll down a couple, to the one where it's the AI leadership. So you can again see that in 2025, the white line there is the S&P 500, and then the yellow line is the S&P 500 equally weighted. So it has relatively less hyperscaler exposure.
Continuing on, Sebastian, in the thread, what exactly is this chart showing?
Investor appetite's clearly less sanguine than it was like a mid-year, but there's still a lot of reasons to be, constructive on equities and risk assets and crypto kind of as we go forward. One thing that's interesting in the stock market that people are talking about is, after such a pronounced leadership from the hyperscalers, which is like the Mag 7 or whatever, and such, that maybe like the equal weighted S&P 500 might be a more interesting play kind of next year, which is the yellow line on the chart here. And so that's like the same companies that are in the S&P 500, but instead of having market cap weighting, they're all equally weighted. So you get a lot more exposure to the smaller companies and the non Mag 7, Mag 10, whatever it is. So you have an equal kind of exposure to all those firms. And so you see that the yellow line underperformed a lot this year as the hyperscalers kind of like took off. And so like if you're constructive on the broader kind of like equity risk backdrop, but maybe people there'll be a little bit more apprehension in the AI space, then the yellow index might be a better kind of bet, which is interesting. And if we kind of bring that to crypto, I think we've kind of been living in that already, where there's like this kind of basket of crypto assets that are like really doing well, versus like the average that's not doing super well. And so I think actually it's like this is an interesting kind of case in equities. However, I don't know that you'd have the same kind of situation in crypto where you got to think like I think if you went to like equal weight crypto index, it'd be more of an underperformance this year and like probably not the best place to be. But all that to say is like the strategists out there are pretty are constructive on stocks as we move forward, and a lot of it just like comes down to like I had a few tweets along this similar vein this week, is just the idea of like trades got too crowded, people wanted to go and lock in profits for the year, and then that created some initial selling, which was added to by fears around this AI bubble, and then the momentum algorithm started to like come out as well, and then you kind of had this like mini cascading decline, which was felt a lot more in crypto world where people are a lot more leveraged and kind of hinging on like the P&L and that kind of stuff a little bit more than in equities. But all that to say is the backdrop's still constructive, things are still looking pretty good. And so like at least and I'm not a trader per se, but I don't think the broader bull market is over yet in risk assets or crypto. And I'd encourage people to kind of go through it. It's got some different kind of like anecdotes, but like generally speaking, I think the tone is one of like, okay, like the crowded trade got a little over, people got a little overextended, and then we got this like kind of rush to protect P&L for the year, and then but yeah, ultimately things are still pretty good and we should resume higher in time. So but this both Scott and Tony, like I don't know them personally, but they're great analysts to follow, and they both kind of share the same idea of upwards we go after you work through some of this systematic selling.
All right, and what is Kedrosky? So this is in terms of like the AI bubble, right?
Yeah, so I watched this. I listened to this podcast last week when I was kind of out on my run, and I thought it was really, really interesting. So the Odd Lots podcast was two folks from Bloomberg Media, and they had Paul Kedrosky on there to talk about how this AI bubble is like an everything bubble. And I'll encourage people to just go listen to it. It's really fascinating. It's pretty plain language, but what you're finding is that so you have like a data center that is important for someone like a Google, for example, to use to run inference models and try to advance the cause of AI to maybe towards this AGI kind of idea, but certainly like improve on its models to try to like win market share by having the best predictions or best predictive intelligence out there. So uh, they, you know, can put on some debt on their balance sheet. So raise debt to go and then build some of these data centers. But shareholders don't love to see a ton of debt creeping into the capital stack, because it means that like there's a lot more risk in the equity side of things, right? And so some debt's okay, too much is a real big problem. And so what you're having is like some of these hyperscalers, Meta, I guess, is kind of like pushing the envelope on this one, but they're setting up kind of like sidecars. They're called special purpose vehicles. And so effectively what they are like a kind of a contractual agreement whereby this vehicle will raise money separately, and it will build a data center that Meta will then be able to use for inference. And the accounting of that means that the debt raised to go and build this thing doesn't have to show up on Meta's balance sheet. They
Hmm.
may end up having some additional expenses that show up, but really they get to use this thing for like what looks like a more capital efficient in a more capital efficient way. So that's not inherently bad, but like Enron was famous for its SPVs, and some of these other kind of like constructs in the past have been tied to high profile kind of collapses in kind of corporate history. Um, and then what's happening too is what will happen is like you'll have a data center that maybe, for example, is 80% leased to a hyperscaler like a Meta or a Google. And then to like enhance the returns on that, because those guys are big, right? Like they're not going to pay as much as like some of these smaller projects might. So you start to layer in other people who might want to pay a bit more for access to these um, uh, GPUs, and they're willing to pay a higher amount. And so you have this like data center or a portfolio of data centers that has like a mix of tenant health and strength or whatever else, and you want to make like fixed income securities out of it, or like these are like bonds. And so what you want to do is like, okay, you want to sell this bond to a pension fund, and you'll say, hey, this pension fund, like I can sell you this bond that's going to pay you like, I don't know, 6 or 7% or something like that, and it's got a very very high credit rating, and it's above the 5% or whatever else you're going to get on U.S. Treasuries. And so you're like, okay, like I like this idea. But what they're doing is something similar to what they were doing in the subprime mortgage crisis, and they've taken the basket of loans, and they've kind of like securitized it to say like, this amount of the portfolio will earn X amount of interest rate, and then we'll have like we'll incur losses the last, and then other ones will have higher interest rates and incur losses sooner. And so you have this tranching, but again, in and of itself, not a big thing, not a bad thing. However, it's reminiscent of what happened in the subprime mortgage crisis, and so it's like, wait, we're back to doing this stuff already. And they talk about that, and like how this whole thing could play out over time. It's really fascinating, great listen. And I'd encourage readers to check it out, or check out the tweet where I kind of summarize some of the findings there.
Yeah, it's still that AI bubble um fear is still there, especially when you have somebody like Michael Burry, right? Like from The Big Short, talking about it, since he was right on the money about the real estate industry back in 2008. So obviously his opinions carry a lot of weight, and a big reason why fear is still hanging over us. All right, so moving on, Sebastian. What about in this particular tweet? You are highlighting Gavin Baker. I personally haven't heard about who he is. Can you shed some light about this?
Yeah, like so he's an investor, and like a pretty prolific writer with in the tech space. And so he has this really good write up about AI and kind of where we are, and that it's it might be the kind of thing that people want to use AI to summarize to kind of help with some of the jargon and stuff. But effectively, he finds that like this new Gemini model does show a real big step improvement um, from like previous models. And so there was after OpenAI oh 05 or whatever else, people were like worried that like, oh no, we're starting to, or ChatGPT 5 or whatever else, we're losing like the rate of improvement is starting to curtail. And then in the kind of North American models versus some of the Chinese models were showing kind of like these real big improvements on lower kind of compute levels. This new model apparently kind of breaks trend and shows like, hey, there's still capabilities here. And he talks a lot about the lag of some of the new models that are coming in now that required these Blackwell chips from NVIDIA, and just like how we haven't really seen that kind of come to market yet. And so he thinks there's still a lot of like upside to what we'll see there. And he kind of introduces the idea that these inference models, the tokens that they produce, or the outputs are not homogeneous. And so, like from a like a commodity standpoint, it'd be like grades of crude, I guess, or something like that. And so he was saying how like this will be an important kind of step, like an important kind of consideration as we go forward. Because like I think a lot of people, myself included, kind of like thought compute was this like just compute, it's commodity. It's like that's what you get, but it's like no, like how you use the electricity to produce the token is going to like make for like a better output. And that's going to be really important on a go forward, and kind of like start to like separate winners from losers in the space. And so yeah, it's a fascinating read. Just kind of talks about like how like we're pretty far from like bubble times. Like there's a lot of constraints, again, kind of going back to some of the things we talked about before, like the physical world, that make for an overbuild to be very difficult. And then that's talked about in the Odd Lots podcast as well, which is saying like some of these, there's got kind of some natural buffers that will like make it so even though people are saying they're going to spend so much money, they may not actually be able to. And then we are seeing continued improvement on the model side of things. So I guess just kind of a very thoughtful write up from Gavin on like how, you know, there's a lot of fears about bubbles, but you know, doesn't sound like we're there yet. So, and you know, maybe a lot of reasons to think we don't get there
Does it
for a
surprise
while.
you at all that ChatGPT is not even, ranked here on this initial image that we're showing?
Yeah. So, he talks about that, and so I guess the latest version of ChatGPT was like a step towards like cheaper model. So like tokens not being as you know, high grade as some of these other ones that are
Mm.
starting to come out. And so yeah, and you know, he makes the allusion to, you know, like the internet, the MySpaces and stuff like that that had to kind of go away. So you know, we'll see.
Go back to the banking side of things and crypto. You also had this thread, which talks about how the banks are now able to use blockchain and be able to use crypto to pay the network fees. And the biggest question that I had is, how valuable is this to the actual networks like Solana, like Ethereum? Do they have anything to gain from this? Do they become more valuable by doing this? Would they be using the network enough for value to be driven to these ecosystems?
Um, I mean, I think the short answer is yes. Like it's directionally positive, whereby so like the two announcements are on the one hand, yes, U.S. national banks can hold crypto assets to do transactions. So that's like, you know, if the idea they're going to lead with stable coins, but they have to have some ETH to be able to transact on Ethereum, then that's good. And then in the same week, we had this announcement from the Basel committee, sorry, that said, you know, we're going to have to rethink our capital rules because they kind of had lumped stablecoins and Bitcoin in the same kind of grouping, and now with pressure from the U.S. and the U.K., they're saying, okay, well, we have to rethink this and do it quickly, is what they've said. So I think, you know, just off of that, you have the Office of the Controller of the Currency in the States saying, like, you know what, banks can hold these assets to transact on chain. That obviously suggests demand from them and a willingness to transact that way. Then you have the oversight committees, you know, for you know, bank risk saying we have to review how we kind of think about crypto assets. And then actually something that came out recently too was that Citi completed a uh, like a fiat to crypto transaction and are doing more on chain as well. So I think like I know prices are down and people are bearish and all that kind of stuff, but like this is huge. And I think what does it mean specifically for Solana price? I don't know, but is it good for the Solana and Ethereum networks that big banks are now allowed to transact on them? Yeah, absolutely. Like between we saw like last week, I think JP Morgan minted some JPMD on base and all that kind of stuff. So this is happening a lot more, and now you're having the regulators kind of pivot their policy around it too. So to me, it's unequivocally good. Like I don't know if it's going to like moon people's bags tomorrow in terms of like sold the asset, but I mean it directionally positive for usage.
I feel like as an industry, we're moving, at least based on where we are right now, we're moving away from this, speculative mindset to more of, okay, business 101, does this business generate revenue? And when you look at the way that, these networks generate revenue, I mean, using the network, obviously, right? So to your point, I think that with this new mindset, this is very bullish for the entire industry.
Yeah, definitely, man, for sure. Like there's actually been Santiago Santos had an interesting piece that came out late this week that I'll kind of distill. We could talk about it next week, but it kind of talks about like the other side of that. And it's like, okay, cool, but like, what are we pricing today in terms of future activity? And that's something that I want to spend some time to like, think about and like kind of come back. And we can talk about that next week as an interesting kind of dovetail to this. So it's like all this activity is happening, token prices are going down, like could that be because the valuations of these networks are too high given like where we're at or where maybe even where we will be in 5-10 years? It'll be a good one to go through.
Yeah, definitely something to digest because, what we've seen from the cycle, so many great pieces of news coming out. Like, for instance, like Pith Network getting tapped to be the GDP data provider on chain. That's huge, to be able to work with the government. When you look at the price of Pith, that's not, that tells a completely different story. So there is this like huge divide between the price, and we've shared this before too with like plasma, for instance. What's happening on the utility front is completely different from what's happening on the price front, and not really sure what it takes to kind of converge, but would love to dig into your report once you have it. Sebastian, that pretty much covers it up. I think we covered just about everything for over the past week. I'm gonna put a link to your X account so people can actually like, follow along and read your stuff. But of course, we'll be here on a weekly basis going over this. Thanks so much for joining. And for those that are watching, if you found this video helpful, please like the video, subscribe to the channel, and don't forget to give Sebastian a follow. We'll see you guys in the next one.
Thanks, everyone. Thanks, Mikhail.
If you're a founder or operator in Web3 and want to connect with others like you, head on over to networkspotlight.io and apply to become a member. See you on the inside.